Welcome back to Market Call, peeps. Hope you all had a wonderful Valentine's Day. I'm Guy Adami. I'm always joined by Dan Nathan later. Check this out. We'll be talking to Angie from Forkast News about all things crypto. And you know what about all things, by the way. Today's episode is brought to you by CME Group, Dan, where risk meets opportunity. And of course, Open Exchange, because they matter and they matter. They manage all the virtual meetings that matter for the top companies around the world. Well, 2 days in a row, market rallies off a throttling on Friday, Dan. I guess in large part due to what appears to be a calming over in Eastern Europe.
Yeah, I mean, listen, you and I know we've been in this business a long time. And a lot of times when you see those sorts of geopolitical events, the things that you can put your finger on, you do see a de-escalation, right? Markets climb a wall of worry. I know I just triggered you there, big guy, but that's kind of what we had late last year, a little bit. All of these things that we really can kind of look at. Rising inflation, rising interest rates to combat that, these geopolitical issues, high valuations, they were all there in November and December. The market kept on ripping, right? And so here we are in January, February, and we kind of sold the news. I'm just going to give you every little market idiom guy I can think of right here. And what did they do, right? So they were kind of fearful, greedy, they bought the thing, this and that, whatever. I'll stop right there because I know you're about to fall off your chair a little bit. But when you see something de-escalate like that and you saw it in underlying risk assets, they were definitely had their antennas up. You're going to get this sort of reflex reaction that we had here. But I will tell you, you and I would probably agree too, we're just not out of the woods yet because the Russia thing was just one thing.
Yeah, no doubt about it. And we're going to slide it all and take a look at the S&P. But to your point, I would say, the Russia-Ukraine thing has been out there for a while and the ebbs and flows of the news cycle. But this market didn't start selling off on the back of that. And all the things that the market had been selling off on are still in place. And oh, by the way, Dan, I'm not convinced this Russia-Ukraine situation is over by any stretch of the imagination. So 2 good days in a row. Let's see what the rest of the week holds. But I'll say this. Here we are once again at this 200-day moving average, seemingly a magnet. And we're right in the middle of that range, that upper end of the range, the red line that you drew, that's resistance. Support is well documented, basically around 4250. That represented by the October low and the recent low that we saw. We're smack in the middle of it, and we're smack right on the 200-day moving average.
Yeah, and to your point, that sell-off in January from the all-time highs that the S&P was making early had nothing to do with Russia, right? So here we are. We're kind of in no man's land. We're in that range.
Exactly. So let's take a look at, Dan. The Nasdaq is represented here. These are the E-mini Nasdaqs traded on the CME. Now, this chart obviously looks a little bit different. Here we have a pretty well-defined, in my opinion, bit of a double top. We are still below that support line, the previous support line, which is now resistance. And obviously that coincides with the 200-day moving average, which comes in right around, I think, Dan, 11,000. Oh, excuse me, I'm probably off a little bit. But You get what I'm saying, right about that 15,000 or so level. I'll say this chart does not look nearly as constructive as the S&P chart.
Yeah, and we know why, right? The concentration of those major names in the Nasdaq 100, they made up a disproportionate amount of that index gains over the last year or so, and they obviously led to the downside. The other thing is like we just mentioned, valuations. With interest rates going higher, we saw dozens and dozens of stocks in the Nasdaq 100 absolutely get pummeled over the last 6 to 9 months or so. And we also know that even back in Q1 of 2021, those major names, those 5 or 6 names that make up more than 40% of the Nasdaq 100, they struggled when interest rates were rising higher. 10-year got to 177 in March of 2021. So we're 11 months later here, and it makes perfect sense to me with the 10-year above 2% that high valuation tech stocks that are seeing decelerating growth after a period of hyperacceleration are having a tough time.
They're having a tough time. And what's interesting about this chart, a number of different things, but for me, it's a 200-day moving average, which has been basically lower left to upper right, is now starting to flatten out and actually turn lower. So when you start to see that change, that upward slope now change to downward, that could be a change directionally in terms of a market that's basically been straight up for the last couple of years. I think that's important to watch. I will say this. I do think you're going to see a test of that recent low, and we'll see how it manifests itself Maybe it's in the form of rates continuing to grind higher, or maybe it's some more high-profile misses, which we'll talk about later. But here's the moment of truth chart, and it comes in the form of the small caps, the RTY, Dan. And we've talked about this seemingly every show for the last 6 or 7 months. Very well-defined support levels, as you can see by that red line. We finally broke in January, had that huge downdraft. Now we're sort of grinding back to what was, again, support becomes resistance. What are your thoughts here?
Yeah, this is one, though, I think that you identified a couple months ago in that breakout. And you said if it can't hold, if it can't establish a new range, if there can't be some new leadership out of small caps, which would suggest that maybe we are seeing this kind of reflating sort of economy here. We're getting past, let's say, the Delta variant from the summer. And what happened was we got another variant. We saw things slow down here, right? And so, at the end of the day, I think the Russells, the small caps in particular, have been very rate sensitive. And we know that, they were trading well with rates in early 2021 because at that point, it meant that maybe the economy was improving and therefore rates should come off these unusually low levels here. But now with rates at 2%, they're doing it for a whole host of different reasons, right? Because we have these inflation readings where they are. And listen, at the end of the day, 7.1 in December, 7.5 on the CPI in January. You get another one in the high single digits, and I think a lot of investors are going to be pretty convinced that the Fed had that whole transitory thing wrong.
Yeah, and I've been convinced of that for a while, and obviously had PPI today, which is not as important, but another hot number. And I think you're right. If typically higher rates mean the economy's doing better, which should be supportive of the small caps, but that's exactly the opposite of what's happening now, because obviously inflation is concerned, which takes us to the obvious chart, 10-year yields. And here we are. We talked about it getting to 2%. Here we are, 2%. What was interesting to me, Dan, on Friday when you saw that huge downdraft in the broader market on the back of a whole host of different things, you saw 10-year yields quickly go from about 2.03 down to 191, pretty much in a straight line. And that made sense, and we had actually talked about it on Market Call. I thought you could potentially see lower rates if the market were to sell off as people went to the Treasury market in sort of this flight to quality. And that's exactly what we saw on Friday. But now the market is saying, well, we're back to the old problems. Again, maybe this geopolitical stuff is a little overblown, and now people are getting back out of yields. In other words, yields are going higher. They're selling their Treasuries, and we have rates back above 2% here. I think we're going to hover around these levels for a while because I do think you're going to see fits and starts on the geopolitical front. So every time you get bad news on that front, I think you'll see yields go lower. And every time it seems like the coast is clear, I think the trajectory higher continues. But it's going to be ebbs and flows here, Dan Nathan.
Yeah, last night on Market Call, we talked about Mike Wilson from Morgan Stanley, his call that if Russia were to invade Ukraine, it would be a polar vortex. And really what he was saying is for the economy, it just would kind of push things into a recession. We know that supply chains are already really exasperated here and only make things worse. Obviously, if you're worried about inflation, you have to be worried about input costs, whether it be oil and nat gas, and those aren't doing particularly well. I think the 10-year probably comes back to that breakout level near 175 or so. Maybe your 2-year continues to go a little higher. You've had a call for a flat or flattening yield curve, and maybe that's how we get there, Guy.
Yeah, I thought in terms of flattening yield curve, I thought we'd see 30 basis points in the 2s, 10s, and I thought we'd see it in the form of 1.5%, which we're basically at in the 2-year, and 1.8% or so in the 10-year. So I'm a little bit off, but not that far. As a matter of fact, I think the 2s, 10s got down to about 41 basis points or so. We'll see how it plays out. The next obvious one to look at, though, given what's happening geopolitically, is the HYG for me. And Dan, I think the HYG is interesting because, again, something that typically does not trade at all. You've had a couple of downdrafts if you go back and look over the last 5 years. You obviously had one at the end of 2018. I can tell you exactly why that was. That's when Jerome Powell basically said we were going to raise rates and we were going to be on autopilot in terms of reducing the balance sheet. The broader market sold off close to 20%, and that's what that chart represents. The obvious one, obviously February, March of 2020, we all know what happened there. But now we're starting to roll over once again in the HYG. And this is something, Dan, I think people need to keep an eye on Because this could be, as the police said, the canary in the coal mine.
Well, right. And so let's kind of break down why this is important. And when you go back to 2018 and you see that at about like some point in Q3 or kind of mid-year or so, you started seeing high yield credit. You saw spreads widening a little bit. And there was two things going on at the time. It was, yes, the Fed said they're going to continue to keep their kind of rate hiking cycle on autopilot. But the backdrop of that was also slowing global growth, right? If you think about that, you put those two things together and you have a situation, well, it kind of speaks to potentially why small cap stocks are underperforming right now, right? If they're more credit sensitive, that sort of thing. So to me, is it kind of signaling that we're seeing higher default risk after a period of abnormally low interest rates? The Fed clearly kept their pedal on the metal too long. And what did that mean for corporates and their ability to buy back their stock and do whatever the hell it is? I mean, listen, there was a binge in the credit markets, and we'll see what happens here. Really high levels of debt with potentially slowing growth. The bull case for everything right now is that we see a re-acceleration in growth and a moderation of inflation. And you tell me, when everything has been so clear for the bull case, does it usually happen, guy, in your career? All that being said, with the HYG, if there was a push lower to that 80 level on really no new news, it probably would signal the height of fear. It also might signal that the Fed gets a bit more dovish too.
Well, we'll see about that, but it is an important chart to watch, and I'm glad we're pointing it out because I don't think a lot of people are focused on it, and typically they're focused on it too late. Let's take a look at oil because obviously that's another one that everybody is focused on, and you actually talked about it last night. You thought you could see a sell-off on any perceived détente, again, to use that word, and that's exactly what we saw over the last 24 hours, and oil sold off about $3 or so. Listen, I still think it's in play, but could you see that 85 level, that green line, which was resistance back in the fall, could be support here? Absolutely, but we'll see what happens over the next week or so if this rhetoric heats up or if things do calm down a bit in Russia.
Well, listen, guy, 65 or a little below to 95 just in a matter of a couple months, and you'd think we're in World War III. That's really what happens with oil when you have those sorts of moves. And we've been talking about this chart, this cone in a way, over the last year or so. And you look from those peaks, there have been some significant sell-offs. I just don't know why. Listen, would it have been beautiful if you had a kiss of $100, right? And then you had this sort of move lower? Yes, because you and I know things that go to 90 and 95 usually go to 100 in the markets here, but clearly a move back towards that breakout level is in the cards. And don't think for a second it might not overshoot if everything moderates around the world just a little bit on a geopolitical basis. And then if demand were to be a little softer than people expect, look at those peak to trough declines. We had one of 15%, then 20%, then 25%. I mean, this thing could go back to 75 in a heartbeat if a lot of good things sort of happen also.
That's a fair point. And listen, the next thing to obviously look at then from there is the OIH, because this to me is the most interesting of all the charts. Again, very well-defined range. We've talked about it dozens of times. We're right up against what should be resistance, and we're finding it in the form of 240 in the OIH. OIH is basically comprised of three stocks: Schlumberger, Halliburton, to a lesser extent Baker Hughes. But you've seen that move from 175 to 240 in a straight line. You saw how volatile it was last week. You're seeing the volatility in it now. It is struggling here, and this is your line of demarcation. Given what Dan just said, I think he would submit that we probably see back down to 200 or so, which would represent about a 50% correction of the recent low in this high. I could understand that 100%. I'm not ready to give up yet, but given this chart, as we pointed out a number of times, the 240 level to take profits makes a lot of sense, Dan Nathan.
Well, I got to tell you this. When you have a move like that in the underlying commodity, and then you have the oil service ETF close up on the day, it was basically down a few percent in the morning. It was kind of a, kind of sell first, ask questions later sort of situation. I do have to take some issue with Amanda Diaz. I love her to death, but man, oh man, if we are going to connect some points, you got to connect those 2 points, the one from June and the one from just the other day, because that would look like a textbook double top guy. And I got to tell you, that's one of the things, I know that you like the oil sector here, but if you just looked at the chart on a 1-year basis, and I know this is a 2-year basis showing the sell-off into the pandemic, if you didn't know that this was related to oil, you'd be like sold to you, because there's never been a double top that I've seen you over the last 10 years not want to sell, buddy.
No, and listen, you're exactly right. We put that game on Fast Money all the time. If you didn't know what this was and just looked at the chart, what would you do? And I think you're 100% right. I mean, here's a level where you take profits. If we were to start to fail here, get through 235, 230, it's to me, it's pretty foregone conclusion that 200's in the cards. So well done by you. But the one that I've loved, and the one that I started trading in 1986, the one that you try to embrace but you can't get your arms around, is gold. And gold gave a little bit back today, but it's fighting a good fight. And we're going to have Angie Lau on in a minute. She has some thoughts on everything we just talked about and gold. But what are your thoughts here, Dan? Is this détente, again, to use the word, enough to knock it down, or is this just short-lived?
Okay, you know what? You sucked me in a couple weeks ago, and at a good level, and I did it via options, so I had kind of defined my risk a little bit. But I said to you, if this gold can't rally, if it can't break out of the range in the environment that we are in right now, it is never going to rally. You're going to have to say goodbye to your first love in the markets here, because this is it, buddy. And if you back this thing out a couple years and you look at that all-time high that it made in the summer of 2020, it's upper left, bottom right, dude. And in this market that we've been in, the one that every investor has known over the last 10 years or so, it's bottom left, upper right. That's what you want to do here. So I'm not sure gold is doing what you think it's going to do. I know you think it's going to be a thing one day. We're going to wake up. I just don't think so.
No, and you've been right so far. We will see how it plays out. And again, if things do heat up once again, I think gold will be significantly higher. But again, we shall see. I'll tell you this, Dan. One of the first albums I ever bought as a youth was in 1973. It was Goat Head Soup by the Rolling Stones. And the fifth song on the first side, you can probably figure it out, is Angie. So we're going to welcome in Angie Lau. Now, I'm not sure Keith and Mick were writing about you, Angie, but clearly you're on top of mind for us right now. Bitcoin's rallied. A lot's going on here. Bitcoin's rallied 35% from its January low. You've talked about it. Founder and CEO of Forkast News, a digital media platform that focuses on all things blockchain. Before we get into Bitcoin, you've heard Dan and I wax poetic about the broader market and gold. What are your thoughts?
Guy, I think you need to change your horse here, go from physical gold and go to digital gold. But, Bitcoin is one of those horses that, either speed up ahead of the pack and then decide to veer off and munch on the grass somewhere. It's the volatility that freaks out a lot of people. But no, you guys make a lot of sense. It's that geopolitical correlation to also the risk on assets, which is, increasingly Bitcoin, crypto, altcoins, stable coins, that kind of thinking that is also infecting, I would say, crypto because of, just more institutional voices and positions in the crypto market. And so there is a spillover effect. So to your point, the geopolitical risk is always going to be there. Frankly, the Fed moves is what makes Bitcoin and crypto very, very interesting on the inflationary front. 21 million Bitcoin ever to be mined. The last one will probably be mined in 2040. That'll be a long, I don't even know which generation it's going to be. But hopefully, our progeny will benefit from what we're talking about right now. Which is how do you get in the market at these prices?
It's interesting, Angie, that you mentioned that Guy needs to take a look at the digital gold over the gold. And we're going to do that. We're going to actually broadcast that live the day that Guy opens a wallet and buys a little Bitcoin. And by the way, Guy Adami, you knew who Mick wrote that song Angie about. It was about David Bowie's wife. You knew that. And it wasn't about Angie Lau, but she's here with us now. And we might just write a song right here about this. All right. So Guy just mentioned, Angie, you had this really steep downtrend in Bitcoin from an all-time high in November. And what I think is really interesting is yes, it just broke it to the upside. It's contending with its 200-day moving average. I know that a lot of Bitcoin bulls are looking at what the Fed's going to do, and they're very focused on this kind of rate hiking cycle here. and battling inflation, Bitcoin should work really well in that environment, correct?
Yeah, I mean, there's a deflationary hedge bet, and that is obviously the base case for a lot of people who are looking to get in the market, even when it was hitting 30. But I would say that the market fundamentals for Bitcoin and crypto are predominantly different from equity, and so that thinking doesn't necessarily transfer. There's just a lot of different dynamics and characteristics of Bitcoin and crypto that one also needs to consider, and that's the technology front. There is a utility use case for Ethereum. Obviously, we could talk about those prices and where it's forecast. Bitcoin, obviously, as a hedge play, it's the grandfather, it's the digital gold, it's what people are familiar with. But even then, there is increasing use cases from the technology side that potentially one day could see it as a crypto network payment. And that payment rail is also super important to how we look at the prices. I know that you talked about S&P. I think this is super, super interesting here. 98% increase over the past 5 years, right? And then correlate it to gold. It took, to buy the index, it would take 2.67 ounces of gold back in January to buy the index. And if you take a look at how much ounces of gold it would take to buy Bitcoin, you're looking at, 25, 26 ounces. So that in of itself, Guy, come on. Are we going to win you over yet?
You clearly won me. I mean, you won me over before we even started the show. Dan's got a quick question, but here I would submit this. If it's not coincidental, in my opinion, Angie, that Bitcoin started to go lower when the Fed changed course, and if the Fed were to divert from their current, in other words, if they got spooked by anything and they went back on this easing cycle, to me, that's when you get your $100,000 Bitcoin.
I think it is. It's a risk off, risk on kind of sentiment there, and a lot of people correlate it as well to those tech stocks that you were talking about on the Nasdaq, right? Even then, it's starting to diverge. There's a move away from tech stocks. We're seeing tech stocks go lower, and we're seeing Bitcoin, whatever Bitcoin price is doing right now, it's not following the trend of tech stocks at the moment. So often I feel like people are trying to figure out correlations. First it's gold, then it's tech stocks, then is it to the equity markets? And I do believe, and you can see it very clearly in crypto, that the volatility reflects a behavior that is different, and it is generational. I think it is the network effect. It is more about the retail sentiment, and it is also, if you think of it beyond the speculative nature of it, it is also the fundamental of the technology.
Yeah, you bring up a great point, Angie. And I think that investors, let's say new to crypto, and I don't like to call them cryptocurrencies. I think that's a bit of a PR problem for some of these crypto assets in general. I think you almost want to think of them as kind of high growth tech stocks that are not kind of kicking out cash flows, and that you can see as a really important part of, let's say, an investment portfolio over a long period of time that might be really disruptive to a bunch of existing technologies, right? And you think of the entire market cap at 1.7 trillion, it's just not that big. It's like the size of Amazon or something like that. So what do you tell investors, like how they should think about it? Like Bitcoin at an $800 billion market cap is kind of like Nvidia, and Solana at 32 billion is kind of like Twitter or something like that. So you would allocate towards those individual positions the way you might allocate towards one position in your portfolio, which would normally look, by most people that I know in the stock market, no more than like 5%. And if you get crazy appreciation, because these things can double and stocks usually don't in a year or so, they have over the last few years, then you look to rebalance, that sort of thing.
But I think it's also how you view legacy stocks versus high growth stocks. Why would you take a risk in high growth stocks? Is there a direct correlation there to legacy stocks? I mean, the growth rate of some of these startups and technology, that's the bet. And you're betting on hockey stick. There is a long runway, and we are in, many would say, the first inning. We haven't even rounded first yet. when it comes to this technology play. We are looking across industries, and every day there's a new trend emerging. Let's talk about also the sentiment, the market expression of Bitcoin prices, and I will tell you, it is probably the tip of the iceberg. It is barely the story. There is so much depth to blockchain and crypto and this Web3 industry beyond just price fluctuations. Take a look at that fear and greed index. This is a great, I mean, it shows the why the narrative is somebody else's narrative, and you got to take a look at it. January 11th, 2021, 35,000 for Bitcoin. That was 2021. Look at the fear and greed index. The sentiment was extreme greed. The market was euphoric, said that, oh my God, 35, after a high that sat at 19. Wow, this is incredible. Where's the floor? Where's the support? And then 1 year later, this year, we're looking at 36,000 US for Bitcoin. And suddenly the narrative is, wow, this is crazy, that there's no hope, there's no horizon to this. And there's like a lot of FUD that's happening across the
FUD guy. Do you know what FUD is, guy?
FUD.
Fear,
something.
Fear, uncertainty, and doubt. And I think it's really interesting, Angie, that you bring that up. That's a really great chart, that fear versus, year over year. And what's interesting, when that was at 90 back in January, I think Tesla in January of 2021 announced they're putting Bitcoin on their balance sheet. And what's funny, in January 2022, you don't hear any corporates doing that. And I also think it's interesting, I just mentioned Twitter last week with the stock down 55% from its all-time and 52-week highs, just made, and within 6 months ago, the company announced that they're going to take $2 billion of their $7 billion on their balance sheet to buy their crappy stock back. And listen, I like Twitter. It's a good company. I don't know if this new management's the right deal, but man, the stock didn't even rally on that announcement of an accelerated buyback. Can you imagine if they announced that they had bought $2 billion of Bitcoin, what would have happened to that stock? So it's really interesting when you think about sentiment year over year, the price is about the same, or was, but corporates are changing their tune a little bit. Guy has had the benefit on numerous occasions over the last year to talk to Michael Saylor, the CEO of MicroStrategy. And he's really gone to great lengths to teach other corporates how to do this, diversify their balance sheet. Do you think that's a thing that comes back in 2022?
There's no doubt that a lot of the positioning that we saw in the market from the corporate side and institutional side bought in at 30. I know it is a buy signal for a lot of these funds, and whether or not they're public about it or private about it, we are seeing those kind of moves. It's the long-term horizon. You take a look at all of the inflationary fears, the current macro environment, the geopolitical risks. You factor that into what's actually supporting the equity valuations. We all have to still scratch our head. I don't think much has changed since 2008, except the fact that money has gotten cheaper, and people and corporates have been able to buy back and inflate their stock, and that has been the bet that we've seen played over and over again. For crypto and for Bitcoin, it's a different play, and Ethereum. You just take a look at the Ethereum prices, and the sentiment is that while it's at around $30,000 right now, the sentiment is that by the end of the year, it could go to 7. And I'm quoting one of our stories on Forkast.news, where a survey of about 33 crypto experts and analysts viewed the space. And that has a lot to do with how people are actually using it, how it is fueling, gas fees, nod to gas fees there, but how it's fueling NFTs, how it's fueling the metaverse craze, play to earn, play to win. This kind of industry move where you see an enormous economy being created in gaming industry that allows people, and very much across Asia, to earn a living playing for NFTs and earning NFTs. This is the kind of utility that we're talking about. And so, to your point, yeah, got to think about it beyond speculative currency plays. You got to think about it from a utility play, a fundamental, the same way that you would look at a tech stock.
No question about it, Angie. Thanks for joining us. We'll have you back definitely again. Next time, maybe we can drill down into NFTs. But please follow Angie on Twitter at Angie Lau TV, and check out Forkast News. It's forecast.news for all of her latest headlines. Thanks a lot, Angie. Great having you here. Dan, you mentioned FUD. The FUD that I know is Elmer FUD, and that's typically during hunting season. Well, we're in the midst of earnings season, and we got a couple of implied moves on earnings. NVIDIA tomorrow and AMAT. Talk to me, Dan, because you're seeing a big move in both.
Yeah, so the options market is implying about an 8% move in either direction. NVIDIA, that is massive, especially on a day after the stock has rallied, 9% or so. And in AMAT, which we're going to take a look at that chart, the implied move is about 6.5%. The average has been about 4.5% over the last 4 quarters. But let's look at this AMAT chart, because it really is something that, I'm sorry about that, guys. There we go. There's the AMAT chart there. Guy, you've been talking about this one for a while on valuation, on their positioning as a semi-equipment provider here. That one looks pretty interesting, also contending with its 200-day moving average. But Guy, first, let's go back to that SMH, because the semiconductor ETF, that thing had a heck of a day, up 5.5%. What is it saying to you about the broader space? Obviously, NVIDIA was a big part of that, but what is it saying about a group in tech that could lead that Nasdaq higher?
Well, people are not looking in terms of being scared of valuation. They're saying this is a secular growth story, and it's probably true. So a lot of these names that got beat up on valuation are getting off the mat a little bit. And a couple Fridays ago, Carter Worth talked about the ability to buy these names on that low. And if you look at the lower green line, he was spot on, because as he said, it stopped to the penny. We're now above the 200-day moving average. That 200-day moving average has not started to slope lower. That's a good sign. And I think the support's intact here. We're going to find out, obviously, a lot more when NVIDIA reports. That's going to be a huge tell. But I like what's going on. I will tell you, Dan, just looking at an NVIDIA chart, we have sold off considerably since that all-time high back in November. We traded down to the 200-day moving average and theoretically bounced off it. Here we are now at the 100-day moving average. What do I think? NVIDIA is an expensive stock. As you know, it probably trades close to 49 times next year's numbers, 25% EPS growth. They better knock the cover off the ball to get it to the next level higher.
Yeah, no doubt about it. I mean, listen, the thing's had a nice rally. It's probably a pretty difficult setup into the print here. But to your point, trading about 50 times 2023, that's fiscal, that's the current year that's coming up here, and 21 times sales. This is a massive market cap. So they really are going to have to put up some good guidance there. But it looks kind of tradable, Guy. I mean, the flip side of that is if they guide down, I mean, the stock is going through that support, which was that breakout level from October, and that 200-day moving average that lines up pretty well. I guess I'd be more inclined to be a buyer of the AMAT than the NVIDIA here.
I agree with you there. I'm more inclined to be a buyer of AMAT. We're in that range. I think you could actually, if you really have the temerity to do it, I think you could sell NVIDIA here into earnings and look for that move back to 228. We'll see, Dan. But our time is now past. I want to thank everybody for joining us on today's market call. Thank to our presenting sponsors, CME Group and Open Exchange, for helping us all get together today. If you like what you saw, be sure to tune in tomorrow at the same time. We're going to be live at 5 o'clock all week. See you then, folks.
See you then.